Let me give you the headline numbers first, then we'll dive deep into what's really happening. Silver is up over 150% from last year. That's right, more than double. Gold gained 65% in 2025, its best performance since 1979. And here we are in January 2026, and both metals are already up another 20 to 30%. This is the kind of price action that makes people sit up and pay attention. But here's what you need to understand. This rally isn't built on speculation or hype. It's built on something far more substantial. We're looking at a perfect storm of geopolitical chaos, central bank panic, supply shortages, and a fundamental shift in how the world views these metals. The reset alerts are turning red for a reason. Let's start with the immediate catalyst that sent prices soaring this week. Jerome Powell, the chairman of the Federal Reserve, came out with an unprecedented statement. The Department of Justice has opened a criminal investigation against him. Now, officially, it's about the Federal Reserve's headquarters renovation that went over budget. But Powell was crystal clear in his video statement. This isn't about building costs. This is about the Federal Reserve setting interest rates based on economic conditions rather than following what the president wants. Think about what that means. The independence of the Federal Reserve, the institution that controls the world's reserve currency, is under direct assault. Powell stated that the threat of criminal charges is a consequence of the Fed setting rates based on their assessment rather than political pressure. When the independence of central banks comes into question, when you have criminal investigations of Fed chairs, smart money runs to safe havens, and there's no safer haven than gold and silver. This investigation came just days after President Trump has been publicly pressuring Powell to cut interest rates more aggressively. Trump has threatened to fire him, called him incompetent, and now we have the Justice Department serving grand jury subpoenas. 12 central bank leaders from around the world issued a joint statement standing in solidarity with Powell. That tells you how serious this situation has become. Here's why this matters for precious metals. Markets are repricing the risk of political interference in monetary policy. If the Fed loses its independence, if interest rates become a political football rather than a policy tool, the entire framework of trust in fiat currency begins to crack. That's when gold and silver become not just investments, but insurance policies against monetary chaos. And it's not just the Powell investigation. President Trump has been threatening tariffs left and right. This past weekend, he threatened 8 European nations with escalating tariffs unless the United States is allowed to buy Greenland. European Union ambassadors are preparing retaliatory measures. On Monday, gold hit a record above $4,689 per ounce. Silver surged past $94. Every time there's a new tariff threat, every time geopolitical tensions escalate, these metals spike higher. Now let's talk about what's happening with silver specifically, because this is where things get really interesting. Silver isn't just a precious metal, it's an industrial metal, and right now, we're seeing a supply crisis unlike anything in modern history. For 5 consecutive years, global silver demand has exceeded supply. Let me say that again. 5 years in a row, we're consuming more silver than we're producing. In 2025, global silver demand hit 1.24 billion ounces. Total supply, including mine production and recycling, was only 1.01 billion ounces. That's a deficit of over 230 million ounces in a single year. That's equivalent to the entire annual output of Mexico, the world's largest silver producer. And this deficit isn't getting better. Analysts expect it to continue throughout 2026. Why is demand so high? Because silver has become absolutely critical to the modern economy. Solar panels need about 20 grams of silver each for conductivity. Electric vehicles use up to 2 ounces of silver in sensors, wiring, and power modules. Electronics, semiconductors, medical equipment, they all depend on silver. There's no viable substitute for silver's unique properties. It has the highest electrical conductivity of any metal. You can't build the green energy transition without it. You can't manufacture advanced electronics without it. The International Energy Agency estimates that by 2030, just the solar and EV sectors alone will consume half of all global silver production. Half. That leaves very little for jewelry, coins, and investment demand. And unlike copper or aluminum, you can't just substitute something else. Industrial users will pay whatever price they need to pay to secure silver, because without it, their production lines shut down. Now here's where it gets even more critical. On January 1st, 2026, China implemented new export restrictions on silver. China controls between 60 and 70% of the world's refined silver supply. Under the new rules, only large state-approved companies can export silver, and only after obtaining special government licenses. Companies need to produce at least 80 tons of silver annually to even qualify. These requirements effectively block hundreds of smaller exporters who've been key suppliers to global markets. China is treating silver the same way it treats rare earth metals, as a strategic resource, as leverage. The United States added silver to its critical minerals list in November 2025. Russia began allocating funds to buy silver. This isn't just about economics anymore. This is about national security. Countries are recognizing that whoever controls silver supply has enormous power over global manufacturing and the green energy transition. Reports are coming out of companies in China and India offering $8 to $10 above market price just to secure physical silver. That's how tight the physical market has become. There's a massive disconnect developing between paper silver prices on futures exchanges and the actual cost of getting physical metal delivered. In Dubai, physical silver coins were selling for nearly $100 when the futures price was $72. That spread tells you everything about how desperate buyers are for actual metal. London's silver inventories have been draining. Physical silver has been flowing out of European vaults into the United States and Asia. Lease rates for silver, which measure how expensive it is to borrow silver for short-term delivery, spiked above 8%. That's a clear signal that the physical market is experiencing serious stress. When it's that expensive to borrow metal, it means there's not enough to go around. And here's the kicker: most silver isn't even mined primarily for silver. About 60 to 70% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. That means when copper prices are low, silver production drops regardless of silver prices. Miners can't just increase silver output because the price is high. It takes 5 to 7 years to develop new mines. The supply side is completely inelastic in the short term. Meanwhile, on the demand side, industrial users can't reduce consumption just because prices are rising. They need silver to manufacture their products. Investment demand is surging. Silver ETF inflows hit record levels in 2025. Individual investors are stacking silver coins and bars at unprecedented rates. When you have inelastic supply meeting surging demand, prices have only one direction to go. Let's talk about the tariff situation because this is adding another layer of complexity. President Trump initially threatened tariffs on critical minerals, including silver. That threat alone sent metals prices soaring as companies rushed to import ahead of potential tariffs. Then, on January 15th, Trump announced he's holding off on critical minerals tariffs for now. Silver dropped 7% in a single day on that news. But here's what's important: it recovered most of those losses within days. Why? Because the underlying fundamentals haven't changed. The supply deficit still exists. China's export restrictions are still in place. Industrial demand is still growing. The tariff threat was just one piece of a much larger puzzle. Even without tariffs, this market is structurally tight. With Trump's unpredictable trade policy, the risk premium stays in the market because nobody knows when tariffs might come back on the table. Now let's zoom out and look at what's happening with gold, because gold tells us something different but equally important. Gold doesn't have the same industrial demand story as silver. Gold is primarily a monetary metal. Central banks have been buying gold at an unprecedented pace. In 2024 and 2025, central banks were net buyers of over 1,000 tons of gold per year. This isn't temporary. This is a structural shift. Why are central banks loading up on gold? Because they're diversifying away from dollar dependence. They're hedging against currency instability. They're preparing for a world where the dollar might not be the undisputed reserve currency. Every time there's talk of the Fed losing independence, every time there's political chaos in Washington, every time there are tariff threats and trade wars, central banks buy more gold. India's gold market is fascinating right now. Despite gold hitting 5 new all-time highs in just the first 13 days of January 2026, Indian demand is holding strong. Imports held steady in value at $59 billion, even though volume dropped 20% due to high prices. Jewelry demand shifted to lighter weight pieces and lower purity to manage costs, but the demand is still there. During festivals, India was averaging 115 tons of gold purchases per month. Gold ETF inflows in India hit a record 37 tons in 2025. Digital gold purchases tripled. This tells us that at every level, from central banks to individual retail buyers, people are seeking protection in gold. And when protection-seeking behavior becomes this widespread, it creates its own momentum. The gold-to-silver ratio is another metric worth watching. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. For years, this ratio was above 80, sometimes above 100. That meant silver was extremely cheap relative to gold. Now, with silver's explosive rally, that ratio has compressed down to around 50. Some analysts see this as silver catching up to where it should be valued. Others see it as silver potentially overheating. Here's my take. Silver has dual demand. It's both a monetary metal like gold and an industrial metal. That gives it leverage on both sides. When monetary conditions favor precious metals, silver benefits. When industrial demand is strong, silver benefits. Right now, both drivers are firing at the same time. That's why silver has outperformed gold by such a massive margin. But let's be honest about the risks here, because this isn't a one-way street. Silver is a thin market compared to gold. When prices move, they move violently in both directions. We saw a 7% drop in a single day on the tariff news. We could see 10 or 15% corrections as traders take profits. Large speculative positions can unwind quickly. If the global economy slows more than expected, industrial demand could soften. The key question is whether these corrections are temporary shakeouts in a long-term bull market, or whether we're approaching a top. Based on the fundamentals I'm seeing, the supply deficits, the strategic importance nations are placing on these metals, the monetary uncertainty, I lean toward this being a structural bull market with lots of volatility along the way, but you need to understand your risk tolerance and position size accordingly. Some analysts are calling for silver to hit $100 or higher in 2026. Bank of America research suggested silver could potentially reach anywhere from $135 to $309 under certain scenarios, though those are obviously aggressive projections. Gold forecasts are calling for $5,000. Are these realistic? Maybe. Are they guaranteed? Absolutely not. What I can tell you is this: the forces driving these markets are real and they're not going away. The supply deficit in silver is real. The geopolitical chaos is real. The central bank demand for gold is real. The political pressure on the Federal Reserve is real. China's export restrictions are real. These aren't based on rumors or speculation. These are documented facts. For those of you holding physical silver and gold, these are the moments you've been preparing for. This is why we stack, not for small percentage gains, but for the possibility that the entire monetary system faces a reset. When that reset comes, whether it's gradual or sudden, those holding real assets are protected. For those considering getting into the market now, here's what I'd say. Don't chase the rally with your entire portfolio. These markets are volatile. Dollar cost average your entries. Focus on physical metal if you can. Understand the difference between paper claims and physical possession. If you're buying ETFs, make sure they're backed by allocated metal, not just paper promises. And most importantly, view precious metals as insurance, not as a get-rich-quick scheme. The ratio of paper-silver contracts to physical ounces is reported to be 356 to 1. That means for every physical ounce backing the market, there are 356 paper promises. What happens when people start demanding delivery? What happens when the paper market and physical market completely decouple? We're already seeing early signs of this with the price spreads between futures and physical metal in different regions. We're also seeing premiums on physical silver coins and bars remaining elevated even as futures prices fluctuate. Dealers are struggling to keep inventory. Delivery times are extending. These are all signs that the physical market is much tighter than the paper price suggests. If the paper market breaks, if there's a delivery failure on a major exchange, silver prices could gap up dramatically overnight. Looking ahead to the rest of 2026, here are the key things to watch. First, what happens with Jerome Powell and the Fed investigation? If this escalates, if there's an actual indictment, financial markets will go haywire. Second, watch China's silver export numbers. How much metal are they actually allowing out? Third, watch the supply deficit data as it comes in. Is it widening or narrowing? Fourth, watch industrial demand, particularly from solar and EV sectors. And fifth, watch the dollar. If the dollar weakens significantly, that's rocket fuel for precious metals priced in dollars. The technical picture is also important. Both gold and silver are in strong uptrends with higher highs and higher lows. Gold has broken out above all resistance levels. Silver is in price discovery mode above its old all-time highs. But we're also seeing signs of overextension on short-term charts. Pullbacks would be healthy and normal. What matters is whether those pullbacks hold support levels or break the uptrend structure. One thing I want to emphasize: this market is being driven by fear and uncertainty as much as by fundamentals. Fear of inflation, fear of currency debasement, fear of political chaos, fear of supply shortages, fear of missing out. When fear is the dominant emotion, markets can overshoot in both directions. Stay rational, stay disciplined. Don't make emotional decisions based on daily price swings. The bigger picture here is about a transition in the global monetary and industrial system. We're moving from a unipolar world dominated by the US dollar to a multipolar world where multiple currencies and assets compete. We're moving from fossil fuels to renewable energy, which requires massive amounts of silver and other metals. We're moving from monetary policy independence to political interference. These are massive generational shifts. In times of transition, hard assets tend to perform well. Real estate, commodities, precious metals, these are things that can't be printed. They have intrinsic value. They exist outside the financial system. As the paper system becomes more questionable, more leveraged, more politicized, real assets become more attractive. Silver and gold are telling us something right now. They're telling us that something fundamental has changed in the world. The old rules don't apply anymore. Central banks can't be trusted to remain independent. Governments can weaponize export controls on critical materials. Supply chains are fragile. The monetary system is under stress. These metals are the canary in the coal mine. Whether this rally continues straight up, consolidates, or pulls back in the short term, the long-term trajectory looks bullish based on what we know today. But stay informed, stay flexible. Markets can change faster than we expect. What looks inevitable today can reverse tomorrow. But the physical fundamentals, those take years to change. Supply deficits don't disappear overnight. Industrial demand doesn't vanish. Strategic stockpiling by nations doesn't reverse quickly. My advice remains the same as always. Own physical metal as part of a diversified portfolio. Don't over-leverage. Don't invest money you need for living expenses. Understand that precious metals can be volatile in the short term even while trending higher in the long term. Be prepared for wild price swings, and most importantly, focus on the fundamentals rather than day-to-day price action. The gold rush hour is here. The reset alerts are flashing red. Whether you're a long-time stacker or someone just waking up to what's happening, pay attention to these markets. They're telling us something important about the state of the world. And those who listen to what the markets are saying, rather than what officials and media are claiming, tend to be the ones who protect their wealth when systems break down. Stay safe out there. Keep stacking. Keep learning. And remember, in times of uncertainty, those who prepare prosper, while those who ignore the warnings pay the price. The precious metals market is giving us a warning right now. The only question is whether we're listening.